Refinancing is a great way to access built-up equity that's in your home. But with the current high interest rates we're seeing in our economy, it might not always make the most sense. Luckily, there's an option where you can still access the equity in your home without having to refinance your mortgage. Before we get in this video, I ask if you can like, subscribe, and do all that YouTube stuff to help my channel grow and reach more Canadians who are looking to learn about the mortgage and real estate industry. Like I said in the intro, if you're looking to access that built-up equity in your home, refinancing can be a great way to do so. But the issue many Canadians are faced with right now is since rates shot up so high so quickly, if you refinance, you're going to be losing your lower rate and having to lock into current market higher rates. Especially if you took advantage of the low rates during COVID and were able to lock in for an extended period of time, you're not going to want to refinance that mortgage because you'll be surrendering that low rate and now be subject to higher market rates. Luckily, refinancing isn't the only way to access built-up equity in your home, and there's an option that you can actually leave your first mortgage in place and just adding a second mortgage behind. You can actually attach a second mortgage behind your first to access the desired amount of equity you want. So instead of refinancing your, let's say, low rate first mortgage into refinancing that whole mortgage into a higher rate, you'd be keeping that current first mortgage in place and only paying a higher rate on the equity portion you're taking out. I'll be showing an example later on in this video to help you get a better understanding of what I just said, but another benefit is since you're not breaking that current first mortgage, you don't have the potential to pay a prepayment penalty. So the overall goal of a second position mortgage is just to save you the most money and put you in a scenario that makes the most financial sense for you. So like I promised, here's an example. Let's take a mortgage balance of $400,000 and the home is valued at, let's say, $750,000. Let's say you locked in during the pandemic to a rate of 2.5%, and that's what you currently have right now to date. Here's the difference in cost of borrowing if you were to refinance that whole mortgage or if you were to just put a second mortgage behind your first. And for this example, let's pretend you want to access $100,000 in equity. So scenario one, you're refinancing your mortgage as a whole. You'd be losing that 2.5% interest rate and be locking in to current market rates of approximately 5.24% we'll use in this example. With that $100,000 of equity, your new mortgage balance would be $500,000 and you'd be paying that 5.24% on the full amount. Your mortgage details would look like this. So your mortgage payments would be $2,976. The total cost of borrowing over the term would be $178,602, $122,791 of that going towards interest and $55,811 going towards principal. Now, if you were to keep that first $400,000 mortgage in place, but then just added a second mortgage behind that first position mortgage for a total of $100,000, the same desired amount of equity, you'd keep that $400,000 at 2.5% rate, attaching a second position mortgage for $100,000 at a rate of 9%. Now, why am I using 9%? Those aren't current market rates because second mortgage is viewed as a riskier than a first mortgage because if power of sale does happen and you got to sell the home, the first position mortgage has dibs over the proceeds first, and then the second mortgage will be paid out. So it's a little bit more risky because there's a first mortgage in front of that getting paid out guaranteed, and if there's enough money to pay out the second mortgage, then it'll go to that. So rates are going to be higher, but keep in mind we are paying this high rate on a much smaller amount. So your mortgage details of the first mortgage would look like this, and the details of the second position mortgage would look like this. So combined, your payments would be $2,619, and the total cost of borrowing over the term would be $157,190, $88,857 of that going towards interest, and $68,332 of that going towards principal. So that's approximately $350 less in monthly payment for scenario 2, and approximately $21,000 saved in total cost of borrowing over the term of your mortgage. Also, scenario 1 isn't even taking into account a potential penalty that you'd be paying, which would increase your mortgage amount, mortgage payment, and total cost of borrowing over your term. Yes, you would be paying that 9% interest rate, which is much higher higher, but it's only on the $100,000 equity portion, not on the full $500,000 mortgage if you were to refinance your whole mortgage. So looking at the numbers, the second position mortgage would make way more financial sense than refinancing your whole mortgage. Now what we do is match up your second position mortgage to mature the same time your first position mortgage matures. So when it is time to renew, we combine those two into one first position mortgage. So overall saving you the most money. I hope you got something out of this video. If you did, please like, subscribe, and share this video with a family member or friend who'd also benefit from seeing this. Don't forget, I have those 3 free mortgage guides to help Canadians get a better understanding of the home buying process and mortgage industry as a whole. So the first one is a first-time homebuyer's guide. The second is a refinancing guide. And the third is you found your dream home. Now you need to obtain financing. So those, link description below, definitely go check those out. And then if you have any questions, please comment below. I'll be sure to answer every single comment. Or if you'd like to book a one-on-one call with me, I have my calendar link below. So go fill out a time slot and I'll be happy to answer any questions you have.